What if I told you that the money in your bank account isn't really yours? That every dollar, every euro, every yen in circulation exists only because someone, somewhere, is in debt? It sounds absurd, but beneath the surface of the global economy lies a structure so intricate, so self-reinforcing, that it quietly dictates how nations rise, how they fall, and how you stay trapped in a system designed for perpetual obligation. This is not just about money, it's about control, because behind every government, every corporation, and every citizen, lies the same invisible architecture and empire built not on gold or productivity, but on debt itself. Today, we'll uncover how debt became the foundation of modern civilization, how it evolved from a simple promise to pay, into the single most powerful force controlling economies, politics, and even human behavior. Welcome to the hidden architecture of debt that enslaved modern civilization. Long before the first coins were minted, debt already existed. Archaeologists have uncovered clay tablets from ancient Mesopotamia dating back over 4,000 years that record transactions, loans, and promises between farmers and merchants. But here's the twist. In those early societies, debt wasn't a tool of control. It was a social contract based on trust and reciprocity. If a farmer borrowed grain from his neighbor, it wasn't about interest rates. It was about survival, relationships, and reputation. Debt bound communities together. It was personal, moral, and local. That began to change with the rise of kingdoms and empires. As states grew, rulers realized that debt could fund power. In ancient Rome, the Republic borrowed heavily to finance wars, issuing early versions of government bonds to wealthy citizens. In return, the lenders gained not just interest, but influence. For the first time, debt was no longer a social tool, it was a political weapon, and the foundation was laid for what we now call the credit economy. Fast forward to the late Middle Ages, Italian city-states like Florence, Venice, and Genoa became hubs of trade and finance. The Medici family pioneered early banking by keeping deposit records and lending against them, but here's the breakthrough. They realized that most deposits weren't withdrawn at once. That meant they could lend out more money than they actually held and profit from the difference. This was the birth of fractional reserve banking, a system that quietly multiplied debt out of thin air. When a banker issued a loan, new money entered the economy. That money didn't exist before it was created as debt, and every repayment plus interest fed back into the system, requiring even more debt to sustain itself. This was a financial revolution disguised as bookkeeping. The Medici didn't just manage wealth, they manufactured it, and in doing so, they invented a loop. Gives loans create deposits, gives deposits fund new loans, gives the economy expands on paper. By the 17th century, this principle would spread to Northern Europe and culminate in the creation of something far more powerful, the central bank. In 1694, the Bank of England was born not to protect the people, but to fund war. The British crown was broke after years of conflict with France. This moment changed history. For the first time, a nation's money supply was tied directly to national debt. Money itself became a liability on the government's balance sheet, and the central bank was the keeper of that system. From there, the idea spread like wildfire. France, the Netherlands, and later the United States would all adopt versions of central banking. But this system carried a hidden consequence. To keep the economy growing, the supply of money and therefore debt had to grow forever. Because when money is created through loans, repaying all debt would literally destroy the money supply. In other words, the system requires constant borrowing just to survive. That's the architecture at work, an economy built on a treadmill that never stops because the moment it does, everything collapses. For centuries, gold was the anchor that kept money real. Under the gold standard, currencies were tied to physical reserves, creating at least some limit to how much debt could be issued. But limits are inconvenient, especially for governments and banks that thrive on expansion. In 1914, when World War I erupted, nations quietly suspended the gold standard to print unlimited money for military spending. It was supposed to be temporary. It wasn't. By the end of the war, inflation had ravaged Europe, debt had exploded, and a new type of financial power emerged, one based not on tangible wealth, but on credit and trust. The Great Depression, the Second World War, and the rise of the US dollar as the global reserve currency all reinforced one lesson: the system rewards debt, not savings. In 1944, the Bretton Woods Agreement pegged world currencies to the US dollar, and the dollar to gold. It seemed stable until 1971. That year, US President Richard Nixon ended the dollar's convertibility into gold. The temporary suspension became permanent. The last link between money and reality was gone. From that moment, the world entered a new era: fiat money, backed by nothing but confidence and credit, and debt, once again, became the engine of civilization. After 1971, the architecture of debt went into overdrive. Central banks could now print freely. Interest rates became the primary lever of control, and consumers, encouraged by new forms of easy credit, became the lifeblood of economic growth. Mortgages, car loans, student loans, credit cards, every transaction added to the mountain of global debt. Governments, too, became addicted. Instead of raising taxes, they borrowed. Instead of saving surpluses, they issued bonds. Politicians discovered they could buy short-term prosperity with long-term obligations. The result, by 1980, total global debt equaled roughly the size of the world's GDP. By 2000, it had doubled. By 2024, global debt surpassed $315 trillion, more than 3.5 times the size of the world economy. But here's the dark truth. This isn't a bug in the system, it's the design. Debt fuels consumption, consumption fuels GDP, GDP fuels tax revenue, and tax revenue services the debt. It's a self-feeding loop, and every time the system begins to strain, whether it's 1987, 2008, or 2020, the same pattern repeats. Gives crisis hits, gives central banks intervene, gives interest rates drop, gives new money floods in, gives debt soars higher than before. Each rescue plants the seed for the next collapse. So what happens when the architecture starts cracking? We're already seeing it. In the past decade, central banks have become the buyers of last resort, holding over $25 trillion in government bonds. That means much of the world's debt is now owned by the very institutions that create money to buy it. It's a closed circuit of financial hall of mirrors. Interest rates can't rise too high without triggering defaults. Inflation can't stay high without eroding trust in the currency. And yet, the only way to sustain growth is to keep expanding debt. It's a paradox with no easy exit. Modern civilization is now structurally dependent on credit. Without it, economies contract, jobs vanish, and asset prices fall. With it, inequality widens and real wealth drains upward to those who own the debt, not those who own it. As the saying goes, the borrower is servant to the lender. But in today's world, everyone is a borrower. The architecture of debt doesn't just shape economies, it shapes people. In the past, success was tied to savings, production, and ownership. Today, it's tied to leverage, speculation, and financialization. Housing markets are no longer about homes, they're collateral. Education isn't an investment, it's a liability. Even governments behave like corporations, managing debt portfolios instead of public welfare. And who benefits most from this structure? The financial elite, the holders of debt instruments, the issuers of credit, and the architects of monetary policy. Every crisis concentrates wealth upward. Every bailout protects the few at the expense of the many. And every solution adds another layer to the same system that caused the problem. Debt has become the invisible empire of our age, a quiet mechanism of control that doesn't need armies or chains, just interest rates. Over the years, economists and politicians have proposed countless reforms: debt jubilees, monetary reset, fiscal discipline, central bank independence. Yet every fix eventually collapses under the same pressure: the need for growth. Because in a debt-based economy, growth isn't optional, it's existential. If credit stops expanding, defaults rise. If defaults rise, banks fail. If banks fail, money disappears. So governments and central banks do what they must. They print, they borrow, and they pretend it's sustainable. It's not, but it buys time. And in a political system built on election cycles, time is everything. As economist Hyman Minsky warned decades ago, the longer stability lasts, the more unstable the system becomes. We're now living in that unstable phase where the architecture of debt is too big to fail and too fragile to fix. The irony is that we've been here before. In ancient Mesopotamia, kings would occasionally declare debt jubilees, cancelling all debts to prevent social collapse. In medieval Europe, debt crises triggered revolts, reforms, and redistributions of land. Even in modern times, financial resets like Bretton Woods or the 1980s Latin American debt crisis followed the same pattern. Debt builds, breaks, and gets restructured. The difference today is scale. Never before has the entire planet been leveraged to this degree. Every nation, every corporation, every household connected by the same web of credit. A system where the failure of one link threatens them all. And yet, the architects continue building layer upon layer, bailout after bailout, as if infinite debt could sustain finite resources. So what do we learn from all this? Modern money is not wealthy, it's debt in disguise. Every dollar represents someone else's liability, and the system survives only through continuous borrowing. The architecture rewards expansion, not stability. Governments, corporations, and individuals are all incentivized to take on more debt, ensuring that crises are inevitable, not accidental. Understanding the system is your first defense, because those who see how the game is played, who recognize that money and power flow through the same channels, can start building outside it. The architecture of debt may have enslaved modern civilization, but awareness is the blueprint for freedom. The system isn't invincible, it's just invisible to most. And the first step to changing it is seeing it clearly. If you found this breakdown insightful, make sure to subscribe for more deep dives into the hidden forces shaping our economic world, because next time we'll uncover how money became the new religion of control. Until then, remember, debt built this world, but knowledge can rebuild it.